I got a question to get off in the weeds a little bit on the accounting side of maintenance agreements, because this is one that's always confused me a little bit. So if you collect $179 ahead of time, do you have to reflect that on your balance sheet as like a liability? Because you haven't performed the service yet, right? You got the revenue, but not the service yet. How do you handle that from an accounting perspective?
There's two different approaches to that. So the first approach is to just recognize the revenue and say, I've got the cash, and I know I've got that future liability, and just deal with it. That's the most common way. Most bookkeeping functions or accounting functions do not have the deferred liability account that I think you're getting at set up on the balance sheet. And so that's an acceptable method. It's not very accurate, though, because it doesn't really reflect that future liability of the labor and ultimately the cost. You might have some parts in there and so forth. But it works. The bigger you get, the more problematic that becomes. If I'm a smaller company, it's not really that big of a deal because I can kind of keep my fingers on it. If you get a little bit bigger, you grow your program into the 20,000 maintenance agreement type strategy that you're talking about. You do really probably want to set up a deferred liability account. And so that's the way we teach it. That's the way we recommend it. But that's an accounting discussion. And so what we do is we set up a deferred liability account, and we do not recognize that revenue when we collect it. We literally, it's in cash.
Bellagio, service, great service.
Yeah.
One of the rooms catching on fire.
All right, so we'll go back to the edit. So the second way to do that is to set up the deferred liability account on the balance sheet. Do not recognize that revenue at that time. Put the $179 in cash. So we show cash. We've got the money, but we are going to have the deferred liability account that will also show the $179. Gotcha. And then what we do is when we run the call, we move cash, to payroll, and we debit the deferred liability account so it comes down, and we match the revenue and the costs. So we move that over to the income statement from the balance sheet. So that's really how the balance sheet communicates to the income statement. So each time we run a call, we do it monthly. Successware 21, most of the integrated accounting systems will allow you to do that. So when you run a call, you can click that and it'll move it over for you. So you're taking a portion of that. So for us, it's 1/3, of the transaction that we've collected. The second part of that discussion, Wally, is we sell long-term maintenance agreements. Different states are going to have different requirements for that. The state of Texas, state of Florida, state of Colorado, so they're going to require you to do that, and you actually have to have an insurance and a license to be able to collect prepaids beyond 1 year. In Arizona, we don't have to have that license. We do it that way, though, because it's proper accounting. So if I sell a 10-year agreement and I collect, let's call it we have multiple systems out there, so 3, 4, 5 systems, I might collect $4,000 or $5,000 in advance. I don't want to put that in my cash and recognize that as revenue right now because I've got 10 years worth of future liability out there. So that deferred liability account is essential at that point.
Do you put the cash aside?
The cash we put in a separate account.
Some states you do have to put the cash aside.
That's correct.
And draw it as you fulfill the service.
And then we draw it as we
Gotcha.
fulfill the service. Again,
That's the right way to do it.
That is the correct way to do it, and it's not as complicated as it sounds when you actually draw it on a piece of paper. There's a nice article on the EGI site that gives you the debits and credits and really goes through that process. I also have a little video that we've produced, and we can show you the debit and credit transactions because a lot of accounting people are confused by that. If I have somebody that's doing my accounting that isn't a CPA, that concept a lot of times gets in the way of understanding. And so the companies will collect the money, put it on the balance sheet as cash, and they don't have the deferred liability account. Now it looks like I got a lot of cash. And so I start thinking about, well, I'm going to renovate my building, or I'm going to spend some money on some trucks, or maybe do some marketing, whatever. And what they don't realize is you've got these payroll liabilities plus the taxes, plus the vehicle costs. So we want to establish cost, and we want to make sure that that transaction gets done that way, for sure.